Hello friends, how are you doing? This side Rahul Magan here. I am speaking on behalf of Treasury Consulting LLP as a Chief Executive Officer. As you understand that Treasury Consulting LLP is a limited liability partnership firm incorporated in India having variety of business models. And as you very well understand that we have one of our brand which is Foreign Exchange Maverick Thinkers, wherein we are circulating a lot of videos to a lot of our clients everywhere. This video we are going to talk about the negative interest rate policy, the impact of the negative interest rate policy, which is negative collateral put up by RBS, Royal Bank of Scotland. This is a very interesting video because in this video you will get to know that how RBS put the negative collateral on their lot of clients, which as per the media which is 60, and what is an implication of that, how it will impact the financial markets, and so on and so forth. But before moving higher, let me give you a small introduction of Treasury Consulting LLP. It's a limited liability partnership firm, and we are having following domains. We are having following business streams. One is publication domain, knowledge commerce, treasury domain, corporate and management consulting, auditing, risk and assurance, and accounting domain, B engagement, and fintech. In all the domains we are working except fintech, because fintech is going to be a part of the company by roughly I think December 2017, and we are coming up with our video. This video would talk about, we are coming up with a CD. This CD would talk about corporate governance and scandals. This CD would be available by end of September 2016. By end of October 2016, we would be launching another CD, I think on IFRS 9, analytics using IFRS 9. And by November, we are launching another CD on analytics, which is SPSS, Minitab, preferably your Idea, ACL, and these kind of softwares. So let's move higher. So today we are going to talk about the negative interest rate for collateral. Now, before explaining this chart, let me give you a small background of the negative interest rate. I am going to read something which I got to know from Financial Times London, and I hope you will make it nice. So the varied impacts of the European interest rate cuts are beginning to work their way through the system. In the two different currencies and thus two different monetary regimes, we now have banks charging large depositors for holding their deposit. Excellent. We thus have evidence of one contention, that is the zero lower bound is actually not the zero, it is actually negative in nature. Now what does that mean? It simply means that if all the big clients, now taking an example of Bank of Ireland, Bank of Ireland has clearly said to all of their big clients that effective 10th of October, which is not very far, the rate of 0.10, which is 0.10%, will be charged to all the customers who hold the deposit of 10 million or more with the bank or multiple deposit accounts. Now, there must be a question which is coming in your mind, that why the depositor will put 0.10 or in the bank, what is the reason behind that? But don't worry, that we will explain you. Bank of Ireland also told customer that this is a result of the European Central Bank decision earlier this year to levy a negative interest rate of minus 0.4% on the overnight deposit. Now you understand that central banks across the globe are putting the negative interest rate, but first we need to understand why they are putting the negative interest rate. They are putting the negative interest rate for very genuine reason. They are saying since 2008 central banks are doing a huge amount of quantitative easing, but the money pertaining to the quantitative easing is not hitting the markets, because ultimately banks will share the almost worthless assets to the European Central Bank, and European Central Bank is going to take these assets in their pocket and give them the cash. Unfortunately, the idea or the logic whereby European Central Bank used to give them a kind of I would say money to give to the general people, or if I use a very technical word as per dictionary, to percolate this in the system, is not working. This exactly is not working. So why European Central Bank? So why European Central Bank, Tokyo is a different example. European Central Bank decided to put the negative interest rate in the system. So what they're saying that, excuse me banks, if today I'm getting $100 billion of, sorry, is in pound, 100 billion pounds of assets from you, because 100 billion pounds of asset from you, because of that I'm giving you 100 billion pounds, and out of this 100 billion pounds, what you guys are doing, you guys are very smart, you will again give this money to me. Now once you give this money to me, you are going to earn a rate of interest. So you are very smart. First you are giving your worthless asset to me and you are getting the complete compensation, and then even after getting the complete compensation, you are earning an asset on that money which you are not percolating in the system, because the prime purpose of the quantitative easing was to increase the inflation in the system, which is something not happening. Henceforth, Bank of England decided to put a negative interest rate on these deposits, so that, hello my friends, if you give me $100, I will give you 99.9, as simple as that. So then banks will decide and put this money in the system. That is the reason why, that is the reason why European Central Bank has been putting the negative interest rate into the system. For Tokyo, the scene is little different. It is not that. Tokyo is almost on the verge of crisis, because we understand that Bank of Japan tried very hard over the last several years, in fact not several years, from the last 2 decades, to improve the economic situation of Japan, but unfortunately they failed every time, and now they are in a deep mess, and they have the option like devil and sea. We understand that now they are going ahead with the helicopter money, and there are a lot of things which they are planning to do, but unfortunately there are a lot of things which are not working. So what they have decided, that they wanted to go ahead with a negative interest rate, because they really want the banks to spend the money in the system. But I am not very okay with the fact that the banks would exactly give the money in the system, to be very honest. That is why Bank of Japan also cut the interest rate to negative. The same is the case with the Swiss National Bank. They also decrease the interest rate to negative, right? So there are a lot of central banks across the globe who are on the negative interest rate policy. In fact, if we carefully see that India is also facing a lot of pressure when it comes to the accommodative monetary policy. On the other hand, Australia, where the overnight rate was 2.75%, right now it stands at 1.5%. So there are very less carry currencies which we have in the market. One is Indonesia, which is trading at 7.77%. Then you have Singapore, which is 1.34%. Sitting today, you can also consider Australia, because even though Australia has reduced the rate from 2.75, but still they are offering positive 1.5%, which is much better than the European Central Bank and Bank of Japan. So there is no doubt that negative carry is prevailing everywhere. Henceforth, if a bank would deposit a money, or a client would deposit a money with the bank, which bank if would invest in system, then bank would fetch the negative interest rate. Henceforth, bank are asking a very simple question from us, giving us giving a simple explanation to their clients, that we explain a little later via basically a picture, that sir, if you give me a money, I will charge from you. And this is what Bank of Ireland did. I will further repeat for you. Effective 10th of October, a rate of 0.10% will be charged to the customer who hold deposits of 10 million euro or more with the bank, or having multiple deposit accounts. With this, regardless of the sums involved. RBS has almost did the same. Royal Bank of Scotland is all start charging major financial institution for its cash it holds on behalf of for trading purpose. Now, what do you mean by trading purpose? We are showing you in the next video. And in this latest illustration of the impact of the Brexit, it has stalled. RBS told almost 70 clients to start receiving the negative rates, because they will be charged for any cash to be put as a collateral for trading for complex financial products like futures, options, and respective. Another bank which has joined that, which is HSBC, Hong Kong Shanghai Banking Corporation. HSBC said last year that it would start charging other banks for deposits held in currencies whereby negative interest rate would apply. It means your euro, your GBP, your CHF, your Japanese yen. It confirmed on Friday that the policy would continue and it's not going to be changed. So sitting today, if you're going to have a policy, if you're going to have the policy of negative interest rate policy, you are investing Japanese yen with the HSBC, then HSBC is going to charge a negative interest rate from you. So things are changing at a very fast, and unfortunately the collateral which we really wanted to put in, that is something which is not happening, which is turning negative. As simple as that. Now I'm going to tell you a few things about the European Central Bank also before we move forward towards the presentation. There are a few important facts. Bank of England Governor Mark Carney may be forced to eat his words and backtrack on his adamance that UK Central Bank will not introduce negative interest rate during his tenure. The following are the reasons behind that why UK Central Bank is moving towards negative interest rate. Since Carney took over as a governor in 2013, the monetary landscape has changed dramatically. Back then, the idea of negative interest rate was just an idea. Fast forward 3 years, the Eurozone, Sweden, Denmark, Switzerland, Japan all have a rate below zero. Britain interest rate is now at 0.25%, which is here. You can very well see, look at this screen. Let me increase the size of the screen for you. Look at here. You can see that Bank of England interest rate is 0.25%. Next decision is 15th of September, which is little far because you have at least I would say 35 days to go. At least 30 days to go. You have a quantitative easing program of 435 billion. You have a corporate bond program of up to 10 billion, and current inflation is 0.65%. Target is 2%. Next due is 13th September 2016. Few points why RBS has put think collateral before moving to presentation. The British economy too far unpredictable right now. Re-exit we all understand. The idea of never is a temporary concept for the World Central Bank. In 2010, ECB quantitative corporate buying was unfeasible. In 2015, Monetary Policy Committee was adamant that the next UK rate would be higher, not as dovish. Monetary Policy Committee may be trying to manage expectation. We believe that the part of the reason why a shoot Bank of England, we want to appear to shut to even discussing in the interest rate, maybe just to avoid fueling market expectation. Negative interest rates are not one size fit all approach policy, as it can be tailored to the requirement of the country. Rate cuts are more powerful in UK than in the rest of the world. Answer is very simple. Some structural factors about UK economy suggest that the interest rate have the higher and the clearer transmission in household than other bank, which is known as transmission mechanism of monetary policy, and like such kind of concepts. If you move forward in the presentation, then you will get this. Now currently the negative collateral has been put on options, it has been put on the forward contract, it has been put on the futures trading, and it has been put on the large corporate deposit. We already told you that in the case of large corporate deposit, it is already HSBC has already said that if you are depositing money with me, then I am going to charge something from you. And your Bank of Ireland has already said that I am going to charge the negative collateral from almost 70 banks. Now, if you carefully see that such things are covering majority of the foreign exchange hedging program. Majority of the foreign exchange hedging program this is covering, like you have options, forwards, futures, large deposits, and so on and so forth. So idea is very simple, that over the period of the time, a huge amount of money which involves a foreign exchange could be via option, future, derivative. These all will go for a toss, and this money will basically hit the negative collateral. This is how it would happen. You can see the presentation very well. Now, in this presentation, you have corporates hedged using financial derivatives. It could be corporates come traders, because sometimes traders also hedged using financial derivatives. Now, what are the various things they do? They do receivable hedging, payable hedging, interest rate hedging, overnight index swap, option structures, payoffs, and so on and so forth. Now, since they are hedging, they need to put a collateral with the bank. Now, that collateral is the money. Now, take a simple example. I will go ahead with an example of, say, Cognizant. Cognizant wanted to hedge. Now, Cognizant wanted to hedge. Let us explain this with an example. Let us say Excel. Let us have this example using Excel. Suppose Cognizant wanted to do all sort of hedging, which we discussed here, which is all account receivable hedging, account payable hedging, and so on and so forth. So, they wanted to do that kind of hedging. Now, how do you survive? Now, Cognizant is saying, I give you, suppose, a collateral of you wanted to give a collateral of 10 million. Wait a minute. You wanted to do collateral of 10 million. Suppose the interest rate which you are charging, interest rate which you are, take an example of Bank of Ireland, you are charging an interest rate of, I would say, negative rate. You are charging interest rate of 0.1%. So how much would be impact? Which is roughly $10,000. You can say euro, dollars, JPY, and anyone. So it is 10,000 in currency unit. Now go ahead with an example of a corporate. Those who are putting billions and those who are doing multiple stuff. They are doing OIS. They are doing interest rate swaps. They are doing foreign exchange derivative instrument. They are doing everything, almost everything. Now these corporates who are doing almost everything, these corporates, do you think they would have to, they have any position? Do you think they are in a position to pay the negative carry to the banks? But banks are also right. They are saying if you are giving me the money, then I am not in a situation to invest this money in the economy, because if I go to Bank of England, then they are charging a negative interest rate for me, and that charge currently I am paying from my pocket. So which I am interested that you should pay from your pocket. Now the question is very simple, that like in the earlier videos we talk about that, are we heading towards negative collateral? Are we in CSX, or CSX is getting negative collateral? The answer is very simple. Yes, we are moving towards the negative interest rate collateral, whereby if you do the foreign exchange hedging, futures, or any such program whereby you are putting your money, you have to pay a huge amount of, you have to shell out the money from your pocket. And sitting today, there is no interest rate which you are getting on such kind of collaterals you are able to generate in India. But I'm pretty sure that as there is a lot of stress which is happening on the Indian Central Bank to reduce the repo rate from 6.5% to 5.5%, 100 basis cut, then I may not be surprised that by 2 years or 3 years, with the RBI will say that they are going to charge interest rate, or the banks will say they are going to charge the interest rate on the collateral. That's all because of the failing of the quantitative easing. And here we go. I hope you like this video. The purpose of the video of the negative interest rate collateral. Our next videos are about the Jackson Hole. Our next videos are about the 10 billion scandal that has hit Deutsche, and lot of such practical topic. You are here talking with Treasury Consulting LLP, which is present everywhere. You can see these all are the places on social media where we are present and having a strong presence, not a simple presence. Our clients are banks, financial institution, corporates, and education institution. These all are our clients, and this is where we have the our brand, which is Foreign Exchange Daily Thinkers, which is well available on LinkedIn, LinkedIn FX Club, YouTube channel, Dailymotion, derivative group on WhatsApp, derivative groups on Telecom Act, Foreign Exchange Academies on Facebook, Skype, Google Group, Google Blog, and everywhere. And you're welcome to contact us as Strategy Consulting LLP @gmail.com. Our alternate email IDs is rahulmagan8 @gmail.com. But before winding up this video, we would like to show you approximately 3 or 4 minutes video on the quantitative easing by Bank of England. I hope this video serves you better and link with what we thought, that why the banks across the globe are going ahead for the negative collateral. So here is the video by Bank of England we wanted to show to you before we wind up.
Quantitative easing, how it works. The Bank of England's Monetary Policy Committee has been purchasing assets financed by new money that the bank creates electronically. Often known as quantitative easing, this policy is designed to inject money directly into the economy. This is in response to a sharp fall in demand as businesses and consumers reduce their spending. In short, there's not enough money in the economy. The aim is to boost spending to keep inflation on track to meet the 2% target. Alongside its decisions on asset purchases, the Monetary Policy Committee continues to set bank rates each month. The bank purchases assets from private sector businesses, including insurance companies, pension funds, high street banks and non-financial firms. Most of the assets purchased are government bonds. There's a large market available, so the bank can buy substantial quantities of assets fairly quickly. The Bank of England's injection of money into the economy works through different channels and has a variety of potential effects. When the bank buys assets, this increases their price and so reduces their yield. That means the return on those assets falls. This encourages the sellers of assets to use the money they receive from the bank to switch into other financial assets like company shares and bonds. As purchases of these other assets start to increase, their prices rise, which pushes down on yields generally. Lower yields reduce the cost of borrowing for businesses and households. This in turn leads to higher consumer spending and more investment. Of course, higher asset prices also make some people better off, which provides an extra boost to spending on goods and services. The Bank of England is also buying smaller amounts of private debt, like corporate bonds. These purchases are aimed at improving conditions in capital markets, making it easier for companies to raise money, which they can invest in their business. There's another way the bank's purchases of assets could put more money into the economy. Those selling assets to the Bank of England deposit more money into their bank accounts. So commercial banks have more funds which they can use to finance new loans. And more bank lending supports spending and investment. But this channel is likely to be relatively weak as banks continue to repair their finances in the wake of the crisis. That's why the Bank of England is buying most of the assets from firms other than banks. The extra money the Bank of England is injecting into the economy should increase spending to help keep inflation on track to meet the government's 2% target. Without that boost, the amount of money in the economy would be too low. Spending would be weaker and inflation might fall below target. But as perceptions of an improvement in the economy begin to spread, this will stimulate business and consumer confidence. That will help to underpin expectations the policy is beginning to work, which should itself encourage more spending and keep inflation in line with the target. As it sets policy each month, the Monetary Policy Committee will continue to be guided by the outlook for inflation relative to the 2% target. If the committee thinks inflation looks set to rise above target, it could raise bank rate and sell assets to remove the extra money it has put into the economy.
So that was Bank of England, that how they are doing the quantitative easing, which method they are using doing the quantitative easing, and the money which they are putting, and because they have decreased, they are doing a lot of quantitative easing, henceforth they are putting a lot of money into the system, and that money the banks are not passing, rather the banks are keeping their money in this overnight vault of Bank of England, which is frustrating them, because ultimately once it is not reaching to the people, then after all what is the point of having a huge amount of quantitative easing in the system. So that was the same, just to update you that a lot of things are happening and RBS is putting the negative collateral on a lot of things. I hope you will take this seriously, and I am not very sure that over the period if RBS has started it, your so-called Bank of Ireland has started that, HSBC has started the same, then I'm not sure that how many are on the way, but still nonetheless we wish that we will definitely not have a collateral, negative collateral in the system. With this we say thank you to you, and you have our contact details. This is Rahul from Treasury Consulting. Have a great day ahead. Thank you.